Good afternoon, everybody. Thank you for joining us and welcome to our webinar. I'm an employee benefit attorney here at Butzel, and I've been an employment and labor and employment employee benefit attorney for decades, as well as my co-presenter, Nick Nahat. He's also been an employee benefit attorney for decades and labor attorney. We've both helped clients for many, many years with countless Form 5500 issues. So we're hoping to help guide you in that process today. Nick, would you like to take it over?
Sure, Lynn, thank you. And thank you all for taking time to attend this webinar or luncheonar, perhaps, as the case may be. I know that your time is valuable, and I hope that you'll all gain a little bit more understanding of the Form 5500 and some of the upcoming changes. We're going to be covering some of the upcoming changes, but begin by setting the table for context. For some of you, this context may be old hat, but if so, look on it as a kind of refresher. So to begin on setting the table, we know three agencies have their fingers in the pie on this table. That's the Department of Labor, the DOL, the Internal Revenue Service, IRS, and the Pension Benefit Guarantee Corporation, the PBGC. You may ask initially, why do they have so many reporting requirements? And what do they really do with all this information? Well, the majority of this reporting is to secure the interests of participants in these employee benefit plans. And each of these agencies comes at it from a slightly different, but often overlapping angle. Department of Labor is concerned, especially with issues of fiduciary liability. They oversee the Form 5500. They also oversee the EFAST filing system, the electronic filing system that we'll be addressing later, and posting information on a website that will give you some information about. The IRS, of course, is interested because these plans enjoy certain tax deferred benefits. They share some responsibilities by overseeing some extensions. And they also handle a subsidiary, Form 5500, the EZ, which we'll get into briefly later. The PBGC, the Pension Benefit Guarantee Corporation, compares participant counts in defined benefit plans to certain PBGC filings because they handle insurance premiums based on the number of participants in those types of plans. We'll talk a little bit about the distinction between defined benefit and defined contribution very briefly later. But let's put these new changes in context. How did we get here? Well, the Setting Every Community Up for Retirement Enhancement Act, 2019, is where we begin. It's the Secure Act. The DOL, as a result of certain provisions in that act, began to initiate certain changes in 5500. They delineate them in terms of phases. We've gone through phase 1, phase 2. The changes that we'll talk about soon are phase 3 changes. And we'll see the revised Form 5500 embodying those changes probably in early January. I've seen the DOL say January 1st, but there's probably some flexibility around that date, but we'll probably see it early next year, something to look forward to. So again, phase 3 is what we're talking about today. So let's go on to slide 4, please. One of the key distinctions as you read through this, and we'll talk about the distinctions between pension plans, welfare plans, and I'll briefly address DFEs. The key thing, though, is the distinction between large plans and small plans. A large plan, quite simply, has 100 or more participants at the beginning of its plan year. Now, for most of us, or many filers, the plan year is also going to be the calendar year, although it may vary. Now, again, quite simply, small plan has less than 100 participants at the beginning of its plan year. Now, the practical implication of that divide is that large plans are usually saddled with the obligation to provide an additional audit from an independent qualified public accountant. And that can be a substantial cost. The average might be about $10,000, but I've seen higher, some slightly lower. So with that said, we also have small plans, as I said, who are exempt from the audit requirement, generally speaking, and they can file a kind of cousin form, the 5500 SF. There are also what we might think of as super small plans, or one participant pension plans. And I mentioned that Form 5500 EZ that gets filed with the IRS instead of the DOL. Well, that is what the small plan is obligated to file. The next slide I think we'll be going to is slide 5. And I'll talk a little bit when we get to slide 5, a little bit more about the distinction between, which will be coming up the next, slide 5. We'll be talking about the distinction between defined contribution and defined benefit plans. So briefly, defined benefit plans are plans that define the benefit that a retiree participant is going to become entitled to. They're relatively rare these days. The defined contribution plan is probably what most of us are familiar with. There are different varieties of those, but in large part, they involve the employer or the employee participant contributing to an account balance. Hopefully that grows over time, and then whatever you have as you approach retirement is what you've got. Now, just briefly too, I wanted to mention we talked, or there was a slide about the direct filing entities. They're not as relevant for our conversation today. They're investment arrangements, specialized trusts that manage money from several plans. They compromise maybe about 10% of Form 5500 filings. Anyway, getting back to DC and DB plans, a metaphor that I sometimes like to think of is from biology, the genus and the species. You can think of the DC or DB as a genus, and there are different species of plans that may be identified. You may be familiar with some of these. There are single employer plans. Well, that's pretty easy to understand, one employer. There are controlled group plans, and those are plans maintained by a controlled group of corporations with roughly common ownership. There are collectively bargain plans, Taft-Hartley plans, what are often called multi-employer plan arrangements. That involves more than one employer contributing to a plan, but only one 5500 ends up being filed. Now, if you're a little bit newer, you can contrast that with multiple employer plans, So those are similar to multi-employer plans, but the multiple employer plans were created in order to encourage more small businesses to offer their employees a tax advantage retirement plan. They usually have a nexus of interest in some way, like a trade association or possibly a professional employment organization. Now, there are also things called pooled employer plans, and those are a relatively new creation of the Secure Act. These are employers who are unrelated, so there's not necessarily the necessity or usual nexus of interest, but they're a form of multiple employer plan. You might say they put PEP in the MEP. Finally, there are what are very new this coming reporting year, defined contribution group plans. And we'll talk a little bit more about these and the changes, but as a preview of coming attractions, these defined contribution group plans are going to be able to file together, thereby perhaps saving that audit burden, but they have to have some real commonalities together, including a common plan year, a common trustee, a common plan administrator, and a common fiduciary. So let's move on now to slide 6. As we know now from slide 5, all pension plans have to file unless there's an exception. And here we have some exceptions listed: the unfunded excess benefit plan, the non-ERISA 403B annuity, the simple IRA, the SEP, the pension plan that might be maintained outside the United States for non-resident aliens, primarily for their benefit. Let's move on to the next slide 7 for more no filing requirements or no filing plans, an unfunded pension plan for executives, top hats, an unfunded dues pension finance pension benefit plan, an IRA. Thank goodness we don't have to file for that, eh? A governmental plan, and we also mentioned the one participant plan. Now, if you're dealing primarily with one of these plans that we just said had an exception, maybe you don't need to know much more about the Form 5500 because you're already exempt. That said, let's move on now to slide 8, health and welfare plans. So all welfare benefit plans covered by ERISA have to file the Form 5500, again, unless there's an exception. Often, I'm going to speak in general terms. There are a lot of exceptions carved into the law, the Retirement Security Act, and the Internal Revenue Code. But as you can see from the slide, welfare benefit plans provide benefits. We're probably most familiar with healthcare plans, medical plans, but as you can see, there's a whole panoply here: medical, dental, life insurance, disability, severance pay, scholarship funds, apprenticeship and training. Now, in keeping with the theme of everything you've always wanted to ask, but may have been afraid to do so, perhaps a little bit of a Halloween theme. We've got our little monster here giving you a tease for the B block. Hey, do you have a severance program that's never filed a Form 5500? Stay tuned. All right. So one other thing I'd like to add while we're on this slide is who counts as a participant for the purposes of a welfare plan, Form 5500. Now, these rules, unlike some of the other rules that we're going to be talking about with the changes, are not changing. But as a reminder, who's covered by a welfare plan? Well, a current employee who's enrolled, former employee who might be covered by the plan. For example, somebody receiving COBRA or retiree medical benefits. Or again, a former employee who's elected coverage, but maybe has yet to elect benefits. Spouses and dependents are not counted for this purpose. And again, the employee has to be enrolled in one or more of the benefits in order to be considered an active welfare benefit plan participant. Okay, at least for 5,500 purposes. Let's move on to slide 9. So exceptions, as I mentioned, there would be exceptions. No 5,500 filing required for certain plans. A small unfunded plan, that is a welfare benefit plan that's going to cover fewer than 100 participants at the beginning of the plan year if it's unfunded. Well, let's just tease out that distinction between unfunded and funded. Now, an unfunded plan is going to be financed generally out of employer plan assets or pay as you go in a way. The funded is going to involve an arrangement, usually some sort of trust is going to be involved. And an insured plan will buy insurance in order to cover its obligations to plan participants. So no filing, to summarize, is required for fewer than 100. If you're unfunded, fully insured, or a combination thereof, and not subject to the Form N1 requirements, that is the involvement of a multiple employer welfare arrangement. And we'll talk a little bit more about MEWAs shortly. Now, as a side note, again, on this slide, we talked about how unfunded plans are exempt. This side note here is telling you that a Section 125 plan is also a way in which an employer can offer these health and welfare benefits, a choice between taxable and non-taxable benefits. And that would be considered to be an unfunded arrangement if you meet the requirements. Now, let's move on to slide 10, in which you don't have to file a Form 5500. Again, exceptions. Again, if it's a welfare plan maintained outside the United States for non-resident aliens, a governmental plan, or again, an unfunded or insured welfare plan made for a select group of management or highly compensated employees. Again, that meets certain requirements. Let's continue to the next slide. Also, exceptions. Continuing on with exceptions. Exceptions for the health and welfare filing also include, as you will see here, a plan maintained only to comply with workers' comp, unemployment, disability laws, a welfare benefit plan that participates in a group insurance arrangement, an apprenticeship or training plan, an unfunded dues financed welfare benefit plan, a church plan, or a welfare plan maintained solely for 100% owner and his or her spouse, or for partners and the partner spouses in a partnership. So there are exceptions to filing the welfare plan, just as there are exceptions to having to file the Form 5500 for a pension plan. Now, as a side note here, as an aside, it's important to consider how many welfare plans does an employer have, or do you have as an employer? Now, we mentioned earlier on in an earlier slide the panoply of different benefits that an employer could provide through a health and welfare arrangement, medical, dental, etc. Now, it is possible to have those all be separate plans or to combine them into what's often called a wrap. Now, what's the benefit of creating an overall wrap document for all of these separate benefits? Well, we're coming back again to that issue of The filing burdens, you'll have to file a separate Form 5500 or a variation for each plan if it's a separate one. If you wrap them all up, you're obviously going to save time in your process for completing filing requirements. Let's move on to slide 12. Now, the flip side or flip question to asking how many welfare plans does an employer have is how many employers does a welfare plan have? And that's where we come to this idea or issue of the MIWA, the multiple employer welfare arrangement. And that happens when a group of employers combines their contributions in order to provide benefits for their employees. Now, what happens there is that employers make contributions to the plan based on the number of their employees and their estimated costs associated with each employee. They're a way for usually smaller companies or employers to offer benefits to their employees without a lot of extra bureaucratic paperwork. You can offload that a little bit, as well as share economies of scale. Now, here we have another little monster. Guess what? If you allow another company to participate in your welfare plan, but they're not sufficiently related, then you might be a MIWA. And that can be a scary situation if you don't intend or plan on that. There are always lurking in the benefits world the possibility of accidental MIWAs. If you stumble into being a MIWA by accident, you might have to fix things. And Lynn's going to be talking a little bit about generally how to fix things in general a little bit later. But how might that happen? An accidental MIWA. Well, there are a few different ways, but here's one. Say mom owns two companies covered by the same healthcare plan. Well, there you're getting into the idea of a control group. Test is if there's identical ownership over 50%. Well, mom owns them all. Easy, same plan, not a problem. But then say she passes, leaving one company with say 60% to son A, and then another 60% of her other company to daughter B. Well, you might have now unrelated companies, and you may have stumbled into a MIWA. There are some other examples we can come up with, but in the interest of time, we're going to move on to slide 13, having given you an idea of what's involved there. So slide 13 involves the 80 to 120 rule involving participants. And again, this goes back to the issue of why participant counts are important. This helps mitigate the burden, especially for plans that might be fluctuating between that boundary we described earlier of being a small plan versus a large plan. So this rule allows plans with between 80 and 100 participants as of the first day of the plan year file the Form 5500 in the same category, that is large plan or small plan, as indicated on the prior year Form 5500 filing. And again, it's that number of participants that dictates whether you have a large or small plan. And there's a nice example here of how that might work. Example, if a Form SF, the short form, or the full 5500 was filed for the 2021 plan year as a small plan, and then the number of participants reported was 120 or less, you might elect to complete the next year's plan, the 2022 to Form 500 in schedules as a small plan, filing the SF instead of the 5500. So the last bullet point there notes that plans with fewer than 100 participants filing 5500 under the 80 to 100 participant rule must include an accountant's report if they filed as a large plan in the prior year and they elect to file as a large plan in the subsequent year. If you're filing a large plan, you're probably going to be at least asking the question of whether you're going to be required to file an extra audit. Let's now move on to slide 14. So the new rules, I think we've set the table. We have a good context established. Again, hopefully some of you older hands might have gotten a little bit of a refresher for these issues. Now, though, with that context set, we can talk a little bit about the specific changes. And the biggest one, the flying saucer coming to you on this slide, the headcount method used for determining if the small plan audit exemption applies. So let's move on to slide 15 and talk about that a little bit. There are going to be some modifications to the participant count methodology affecting who files the 5500 as a large plan. The hope is that it's going to relieve the burden for some people, for some plans, some employers, some of yourselves perhaps. So, as a refresher, under current reporting rules, employees who are eligible to defer to a defined contribution plan. So we're talking about defined contribution plans here. Remember those plans with account balances, but elect not to do so are counted as active participants for purposes of this pension form 5500 reporting. Pension plans that have a large number of employees who are eligible and choose not to defer may have an audit requirement if they still meet that audit threshold, right? Remember, plans with less than 100 participants as of the beginning of the plan year are exempt from the audit requirement, again, generally speaking. So many plans have become subject to the audit requirement based on participant counts that include eligible employees, and that creates additional costs for the plan. But now, starting with plan years, beginning in 2023, again, the forms available probably January 1st, the audit requirement is going to be based on the number of participants with an account balance in the plan. So as a result of this change, many plans that were previously treated as large plans may meet the small plan audit waiver, thereby no longer needing that audit, that costly audit. Now, there's a little wrinkle that I want you to consider. Again, if there's going to be one takeaway, I think it would be the headcount methodology for you to focus on, and an additional wrinkle to look out for is that although you might only have less than 100 active employees with account balances, you might still have more than the 100 participant threshold, because you must count, say, terminated and retired employees with account balances, as well as beneficiaries who might have account balances. So keep that in mind when you're reading the new 5500 instructions at the beginning of 2024, January 1st. Let's move on to slide 16 and look at some other changes, other upcoming Form 5500 changes. There are going to be some new compliance questions that are going to be added to various schedules to gather additional information focused on methods used for passing non-discrimination testing, assessing the timeliness of plan amendments and statements. These questions are intended to address a need for gathering this information that was previously obtained under the IRS determination letter process and has generally been eliminated for ongoing plans. Well, you've eliminated that process, but the IRS is still thinking it wants to, still make sure these plans maintain their tax qualified status by following the applicable rules. We talked about that at the beginning. That again helps set the context. So the IRS has stated that this data is going to be used for a variety of purposes, including pre-examination analysis. There probably should be a little monster, or we've got a robot assisting the IRS preparing audit information and document requests, and determining, as I said, whether the plan is up to date for all required law changes. Let's move on to the slide 17. Just briefly, there are going to be some updates to the defined benefit plan reporting. We talked about the distinction between defined contribution to defined benefit plans. Well, certain large defined benefit plans, those with 1,000 or more participants at the beginning of their plan year, are going to have some additional reporting requirements that are going to better enable the PBGC to model characteristics, portfolio characteristics. Remember, the PBGC assesses insurance. They're basically in the insurance industry. So the more data or information they have about potential liabilities, the better they can model and allocate resources accordingly. We're also now coming onto the slides the idea of a breakout of administrative expenses. The DOL is interested in focusing on fees paid out of plan assets, again, to protect plan participants. They want to make sure plan assets are used appropriately. So there's probably going to be an expense breakdown on the Schedule H. There will probably be specific line items for salaries and allowances, contract administrative fees, record-keeping fees, audit fees, investment fees, actuarial fees, legal fees. Legal fees, by the way, always well spent. Let's move on. No, we've still got the DCGs. We talked about the DCGs earlier. So prior to the new reporting rules, you'll recall unrelated employers that had certain common characteristics were still required to file those separate Form 5500s. So the goal of this new reporting option for these plans, remember they had to have those characteristics, fiduciary, et cetera, in common, is to streamline the burden on these plan types. Now, it's really unclear to me how many plans or employers are going to benefit from that new combined reporting option. I'm thinking that likely your third-party administrator who maintains the plan would probably make a proposal to file as part of a DCG. But even then, there are probably going to be subsidiary issues about whether some in the DCG might have to be responsible for an audit, and maybe not others. So there are probably still going to be some details to work out in that scheme. And finally, there's going to be a new Schedule MEP for multiple employer plans. That's just going to standardize some information previously reported. So with that said, I once again thank you for your kind attention. I'll look forward to constructive feedback, but there's still more to come. And at this point, I'm going to hand things off to my colleague to take us home, Lynn McGuire. Lynn?
Thanks, Nick. I think you did a great job laying the groundwork here, explaining which plans are subject to Form 5500 filings and explaining the changes that are coming down the pike for everybody. I'm going to talk about when the Form 5500 is due, and I'm going to use that kind of as a leverage to talk about what do we do when there's a mistake, when something doesn't get filed when it's supposed to be filed. But before I do that, I just want to drop a little disclaimer. Any similarities, real or imagined, between our slimy little alien and any IRS agent, present or future, are purely coincidental. We didn't plan this to be the case, so please don't read anything into it. So first of all, when is a Form 5500 due? All of the required forms, all of the schedules, and all of the attachments have to be filed by the last day of the 7th calendar month after the end of the plan year. Now, that's the general rule, that's the base rule. You can get a one-time extension of time to file your Form 5500, and the extension is up to 2.5 months. And all you have to do is file an IRS Form 5558 by the normal Form 5500 due date. And normally your accountant will do that as a matter of course for you if you need it. And so it happens kind of automatically in many cases. I just want to highlight, all means all, it really does. If you file a Form 5500 and you don't have a required attachment, such as the audit report, you're not considered to have timely filed your report. Your Form 5500 is not complete, so it's not treated as timely. And now we're going to start talking about what happens when that's the case. Next slide, please. So when you fill out the form, if your plan year is a different year from the calendar year, if you're using a fiscal year, you just simply fill in the dates for your fiscal year, the beginning and end dates on your form. If you have a short plan year, you use the dates for your short plan year, the beginning dates and the ending date of that. Now, what is a short plan year? That can happen in a few different situations. It can be the case that you start a new plan and it's going to be a calendar year plan, for example, but you're starting at mid-year. It can be a plan that's terminated mid-year. And so you don't need to report for an entire year because you've distributed all the assets, for example. Or it can be a situation where you've got a plan merger and one plan is going to be merged out of existence. So its last Form 5500 may be for a short plan year if that merger occurs mid-year. So one little piece of relief you do get from the government is if your filing due date is a Saturday, a Sunday, or a federal holiday, you get to extend your due date deadline to the following business day. Next slide, please. So let's talk about what do you do with the Form 5500. When it's terminated, you have to keep filing this form. Even though you said you filed an amendment, you filed board resolutions that say this plan is terminated, until your pension plan's last dollar is distributed, you still have to keep filing Form 5500. The goal for the IRS is that you have all the assets distributed from your plan's trust within a year from the termination date. If that doesn't happen, they don't treat it as a terminated plan. It's still an ongoing plan, and you need to keep filing 5500s. The same is true, it goes without saying, for a frozen plan. Your plan, even though no new contributions are going in, is still subject to regular Form 5500 filing requirements. Now, for a welfare benefit plan, if it's terminated and you don't have assets, it's a little trickier. How do you know when you stop filing your Form 5500? Well, in that case, they focus on the benefit liabilities. If your benefit liabilities have all been paid, all the participants and beneficiaries have received every last dime they're entitled to under your welfare benefit plan, then you stop filing your Form 5500. And the key here is don't mark that box on the Form 5500 that says final return if you still have assets or participants at the end of the year. Next, please. So what about mistakes? What if you missed one of those deadlines? What if you filled the information in wrong? What if you failed to include the right attachments? Well, the government's very forgiving in general by providing a correction program. But at the same time, if you don't do it properly, there are significant penalties that could apply. So you have to file an amended Form 5500 in order to correct any errors or omissions that were on that Form 5500 that you actually filed, if you filed one. If you didn't file one, you need to file one through one of the correction programs. But an amended Form 5500 and any amended schedules and attachments have to be complete and correct in order to make the prior filing correction completed. So if you file a corrected Form 5500, but you still fail to include a required attachment, it's still not done. Your correction is still not done. Next slide, please. So this slide gives you the rules for the penalties. If you fail to file a proper timely Form 5500, or if your filing was incomplete and you didn't have reasonable cause for this failure on your part. So the penalties can be significant. And I'm just putting this up there to let you know that these are real penalties. They really can apply. But again, the government does have relief programs available for you to correct your mistake. And we'll talk about those. Next slide, please. So who are those penalties assessed against, and who's responsible for this mistake? Who is responsible for correcting it? The bottom line is it's the plan administrator. The plan administrator is responsible for completing, filing, and retaining copies of Form 5500s. Now, lots of people get a little confused when we talk about a plan administrator. Many companies hire a third-party administrator, a claims administrator, or some other accountant or a record keeper that handles their Form 5500 preparation for them. They may even handle the filing itself for them. That doesn't transform that entity into the plan administrator. The company itself is the plan administrator. So the company itself is responsible. And if you are in that company and you're assigned by the company the role of plan administrator, for example, some plan documents say the head of HR is the plan administrator, then you are the one that's responsible for these corrections, for taking these steps to ensure that your form is properly filed. The Delinquent Filer Voluntary Compliance Program is the Department of Labor program that can give you relief in the event of a failure on your part to file a full or a timely Form 5500. It not only can give you relief from the Department of Labor requirement that you file a timely 5500, but it can also give you relief from the late filing penalties that the IRS assesses and the excise taxes that can result. You have to go through this process. It's a fairly simple process, but you have to basically take each of the steps in this correction program in order to get this relief. So if you're going through the Department of Labor's Delinquent Filer Voluntary Compliance Program correction process, you have to, step one, file a corrected Form 5500, and you check the box on the form saying that this is being filed under the DFVCP program. Next, please. So everybody essentially has to file their Form 5500 electronically using the computerized ERISA filing acceptance system, EFAS2, other than the two examples that Nick talked about previously, a foreign plan in some cases, and certain one participant plans. If you're using the EFAST online system, web-based system, you can have a service provider do the filing for you. You may not literally be the one who registers for EFAST2. You may have a service provider register and file it on your behalf. Make no mistake, though, that filing is still your company's filing, not theirs. They're not responsible for the contents of that filing. And in most cases, they're not responsible for whether that filing goes through properly. If they fail to do something right and they don't complete the EFAS2 filing, the problem lands on your lap. One of the rules you have to remember is that as plan administrator, you're also required for maintaining copies of Form 5500s. You have to make them available for plan participants and beneficiaries on request. And you have to make them available to the Department of Labor as well as the public. These are public forms. They're not private, despite the fact that many companies are a little uncomfortable about releasing this information. It is available, and you need to make it available to people. You have to keep copies of those Form 5500s in your plans records, including all schedules and attachments with all of the required signatures as part of your plans records. Now, many of you, if you're using some service provider to do your filing for you, you may just simply get an email from your service provider saying we've filed it and it's deemed signed by you when you do this electronic filing. You need to keep a copy of that documentation that you electronically signed it. Next screen, please. So if you filed Form 5500s in the past and now you're sitting here realizing I don't have copies of those, I didn't keep copies of those, there's a simple Department of Labor website that you can go to and find them. You can pull them up and download copies of them. You can also look at other people's Form 5500 filings. As I said, these are public documents. So we're providing you the website here, but basically this is another way that you can make sure that you're in compliance by getting the documents into your records that you need. Next slide, please. So at this point, we're going to switch over to any questions and answers that you might have. Please feel free to use the Q&A function on the screen to pose your questions. Well, while people are thinking about that, let me just sort of salt the mind by giving you the first question. What does it cost to use the Delinquent Filer Voluntary Compliance Program? Well, there isn't an upfront fee, but there are penalties that have to be paid when you use that program. The penalties are capped, however. For a small plan, they're capped at $1,000. For a large plan, they're capped at $2,000 per filing or $4,000 all over for total filings that are submitted. And generally, when you miss more than one Form 5500 and you correct it, you submit all of them together as a single application through the Delinquent Filer Voluntary Compliance Program. I don't see any questions still, so apparently we've covered it all. We really have answered every question you were afraid to ask.
And with that, Lynn and Nick, I would like to extend our thanks and also our appreciation to the audience for joining us today. If you have a moment, please complete a brief survey. It'll show in the browser when this webinar ends. And please keep an eye out for the recording and the presentation. And we hope to see you at the next virtual Lunch and Learn. If you come up with that great question after today's program, please reach out to us. Contact information is provided here for both Lynn and Nick. And with that, we wish you a great day. Thank you again.
Thank you.